Hey all, welcome to ShareTrek. This is Raj here. Friends, today's topic is something that is fundamental to our stock price. I would say that at first glance, rising bond yields along with Federal Reserve rate cuts seem contradictory. After all, when central banks reduce rates, borrowing costs drop and bond yields usually follow suit. However, current market dynamics reveal something different, driven by several key factors. I'm going to talk about 6 factors. And also I'm going to talk about whether each of those factors are at play right now. This will help us decide whether to stay invested or start selling the stocks. In exchange, I want you guys to let me know how you look at this and what you think. Let's get started. Welcome back, friends. First, please indulge me for a few minutes. Before we dive into the content, I want to speak to you about something that's dear to my heart. We are a retail investor channel. I'm trying to build a community of retail investors that are fearless in expressing their opinions and sharing their knowledge and ideas so that all of us collectively can do better in the market. I already see a few that contribute regularly. I'm calling on you all to start engaging by writing comments, requesting stocks to be reviewed, etc. Over 3 years, we have now built this channel to be around 20k subscribers, but I want more channel interaction because that's what will help us achieve our goal of being better investors. We are all retail investors. None of us know more than the other, but collectively, when we pool our knowledge, ideas, and strategies, we may do even better. However, we all benefit only when we start sharing ideas, information, and strategies. So please subscribe, comment, ask your friends to join and help grow this channel. That's it. Here's the first reason why bond yields are going higher. I think the first reason could be increased inflation expectations, because even as the Federal Reserve lowers rates, rising bond yields can indicate that investors are growing more concerned about future inflation. Rate cuts are often designed to stimulate economic activity, and if that succeeds, it can inadvertently stoke inflationary pressures. And it matters because if markets anticipate that Fed's rate cuts will lead to a resurgence in consumer spending and economic growth, bond investors may demand higher yields to compensate for the erosion of purchasing power over the long term. Now, I don't think that is what is happening out here. I think that the market feels the inflation is already in place and it has not been tamed. And with the new administration coming in and the policies that they have spoken about, it's only going to worsen the inflation. So probably the bond market thinks that the Federal Reserve should keep its powder dry by not cutting any more rates. So any rate cut now, like the 25 basis points we may expect tomorrow, could make the bond market feel that they have to send a message, and probably that's what they're doing. Okay. Now, here's the second reason why bond yields could go up. That could be strong economic outlook or fiscal stimulus. Raising yields can also signal investor confidence in the economy's future performance. If the government is simultaneously engaging in significant fiscal stimulus, such as increased infrastructure spending or tax cuts, investors might expect the economy to heat up, leading to stronger growth and inflation. Now, we are talking about a huge tax cut and also reinstating the tax cut that Trump did before. So if Trump reinstates the tax cut that he did before, it is not going to be a surprise. We are going to be in the same trajectory. Then the question will be, did the bond market build in expiry of those tax cuts, or did they build in the continuation of those tax cuts? So the chances of that being a wash is higher than less. However, if additional 2 trillion tax cut happens, that's going to be super inflationary, and I think that could be another message in the rising bond yields. The combination of fiscal stimulus and loose monetary policy can increase borrowing needs, causing the government to issue more bonds. Greater supply of bonds, if not matched by demand, leads to higher yields. Now, here's the third reason I think yields could go up. The third reason could be the shift in bond market demand. In some cases, rising yields reflect reduced demand for bonds, particularly from major players like institutional investors or foreign governments. This shift can occur if these investors see better opportunities elsewhere, such as in equities or emerging markets, due to a rosier economic outlook or higher returns. I think part of this could be true because the demand for gold from central bank has gone up, but it has gone up only 6% as compared to same period last year. But still, countries like Poland, India, and a few Turkey, for example, they have all increased gold as a percentage of their reserves higher. With Poland aiming to go to around 13%, India is already at 10, aiming to go to 13%. Turkey is around 34% of its total reserves. Now, as percentage terms, these numbers look high, but if you look at the total reserves of these countries, it may not be that high in terms of absolute numbers. But still, the fact remains that if money is going into gold, it's coming out from somewhere. Now, that somewhere could be a little bit from the US dollar, but also a little bit from other foreign currencies that they are holding, like the euro or the pound sterling, because those countries also have US dollar reserves in their balance sheet. So the US dollar weakness goes there as well, plus their own weakness, like Germany, for example, is going through a tough time. France is going through a tough time, and they also have US dollar reserves. So it's a culmination of those things which make the money move from various areas, including US dollar, into gold. So that's the way I'm thinking about this factor. And a rising stock market supported by optimism about growth often competes with bonds for investor attention, leading to selling pressure in bond market and driving yields higher. And that, I think, is one of the reasons that is playing out now, because all the earnings expectations have been stretched. We have highest PE ever. If you look at Tesla, I think Tesla is around 266 PE. That's significant. And the expectation of higher returns has already been priced in. So whether the higher returns happen or not is now the biggest risk for the market. So there could be a little bit of cold feet, people taking profits and going to the safety of the bonds. And all those people who are trying to rush into the stocks for those higher returns may have probably sold a lot of bonds. So there are more bonds available and there are less buyers, and therefore the cost is going down. So this, I think, is also probable. I have another fourth reason why bond yields might go up. It's the concerns about US debt levels. And another driver of rising yields could be the concerns about growing government debt. If rate cuts are paired with aggressive fiscal spending, investors might worry about the US government's ability to manage its debt long term. Higher yields may reflect the market's demand for a greater risk premium to hold treasury bonds in such an environment. Persistent bond market skepticism and fiscal discipline can push yields higher, regardless of central bank action. Now, this is where I would say that the bond market could expect a downgrading of US by credit rating agencies if the deficits keep on going up. And right now, whatever is declared by Trump as the thing that he's planning to do kind of gives us that impression if he follows through with it. For example, cutting tax by 2 trillion would mean an increase in deficit by 2 trillion. That's a huge amount of deficit. Second thing is raising tariffs would mean indirect tax on the people, and therefore the commerce activities might go down. But the amount of money collected through tariff may not be sufficient to plug the gap created by the 2 trillion tax cut. And then the third component of the promise is to have Doge slash the government spending by reducing staff. So all those staff that lose their jobs out there, they are going to be having an impact on consumer confidence and consumer demand. So all those aspects play into a weaker country, a weaker economy, and the risk of credit rating going down. So that, I think, is more at play. Here is the fifth reason why the yields could be going up. It could be the repricing of long-term risk while Fed controls short-term rates, because the long-term yields are influenced by broader market forces, including investor expectations for growth, inflation, and risk. A rise in yield could suggest that markets believe the Fed's rate cut might not be enough to address longer-term risks such as structural inflation or higher deficits. And finally, here is the sixth reason. The global context and capital flows. Global markets play a significant role in bond yields. If other central banks like European Central Bank or the Bank of Japan are tightening policy or offering relatively attractive yields, US bonds might face reduced foreign demand. Now, right now, China is facing a situation where their bond yields are going down. There is a lack of confidence in the economy. And on the other hand, we have US where the bond yields are going up and it's overheated. So all this talk about tariffs and protectionism seems to be already built in. And what needs to happen is to remove those barriers so that the deflationary forces of China meet the inflationary forces of US and they kind of balance each other out and bring us to somewhere much less risky and much more sustainable. That's my feeling. And rising yields might also reflect a stronger dollar, which makes US debt more expensive for foreign investors and dampens the demand. So in summary, I would say that the current rise in bond yields, despite Federal Reserve rate cuts, is a complex interplay of factors, inflation concerns tied to expansive monetary policy and fiscal policies, a stronger economic outlook driving investor confidence and reducing demand for bonds, increased government borrowing putting upward pressure on yields, global factors such as foreign central bank policies and currency fluctuations, all of these play into the mix. I have data for the first half of 2024 that shows a 6% increase in gold purchase by central banks as compared to the same period in 2023. However, USD as percentage of the reserve for most major countries has remained steady. This indicates that probably other currencies are inheriting the weakness of US dollar on top of their own deficiencies. Therefore, the reserves in other currencies are partially moving into gold. We will not get much clarity until we know if the tariffs and tax cuts along with mass deportation is a reality in the new administration. Currently, the stock market thinks that it is just a bluff, while I think the bond market feels that it could be a reality. So why should we worry about this? Why am I spending so much time thinking about this? Well, as yields rise, bonds provide attractive, low risk return, and money will move into bonds for lower risk and higher return and will move out of stocks and other asset categories as there is high risk, and the higher PE of stocks has already been baked into super earning expectations that may or may not come true. It will also exit to an extent from gold because gold does not provide annual returns despite protecting the value. Gold will preserve the value of the dollar, but it's not going to give you a rate of return. So I predict that Bitcoin and Ethereum will also fall along with stocks as both of them have higher volatility. And I'm planning to do a video on gold, how the reserves are changing in the central bank, gold is moving in, and I have some interesting insights to share with you on that. But now here is your turn. Let me know what you think the rising bond yield is trying to say according to you. And I have sold almost 60% of my holdings and booked profit. Was I right? Is it time to sell the rest and wait for the fall? Let me know your theories as well. So I look forward to your feedback. I look forward to more interaction. Help grow the channel. Share and subscribe. Bye for now.